How do I choose the right strike price for into money? ITM options. Have you ever wondered how to select the perfect strike price for into money options? It can seem tricky, but understanding a few key concepts can make it much easier. Let's break it down step by step. First, let's clarify what into money options are. An into money option means that the strike price is favorable compared to the current market price of the underlying stock. For call options, the strike price is below the current stock price, giving it intrinsic value. For put options, the strike price is above the current stock price. This intrinsic value makes into money options more expensive but also more likely to maintain value as expiration approaches. Next, consider your trading goals. If you prefer a higher probability of profit with less risk, into money options are a solid choice since they already have intrinsic value. On the other hand, if you want to take on more risk for potentially higher rewards, you might look at options that are closer to at the money or out of the money, but those would not be classified as into money. Now, let's evaluate the strike price in relation to the stock price. The deeper into money the strike price is, meaning further below the stock price for calls, the higher the intrinsic value and the more expensive the option premium will be. If you choose a strike price that is just slightly into money, you can find a balance between intrinsic value and time value, which can offer both security and profit potential. Speaking of premiums, into money options come with higher premiums due to their intrinsic value. The premium consists of intrinsic value plus time value, which is the potential for the stock price to move favorably before expiration. Choosing a strike price that is closer to the current stock price means you will pay more in time value but also gain a higher delta. Delta measures how much the option price moves in relation to the stock price. Into money options typically have a delta close to 1 for calls and negative 1 for puts, meaning their price moves almost dollar for dollar with the stock. It's also important to factor in expiration dates and volatility. Longer expiration dates increase time value, making into money options more expensive but giving you more time for the stock to move in your favor. Higher volatility can increase option premiums but also the chances of profit. Let's look at a practical example. If stock XYZ is trading at $50, an into money call option might have a strike price of $45 or $48. Choosing the $45 strike means higher intrinsic value and premium but also less risk. On the other hand, selecting the $48 strike means less intrinsic value, a lower premium, but more sensitivity to stock price changes. In summary, the right into money strike price balances intrinsic value, premium cost, delta, time until expiration, and your risk tolerance. It is often selected just slightly below the current stock price for calls or above for puts to capture intrinsic value while keeping some time value and responsiveness to stock price movements. Using option pricing tools and profit calculators can help visualize potential outcomes and break-even points for different strike prices.